The US stock market just closed lower yet again, marking the fifth straight day of losses for the S&P 500. The index is shed about 0.4%, while the Dow and the Nasdaq each slipped about 0.3%. Now, while that sounds negative, let's keep perspective. Despite this pullback, the S&P 500 is only 1.5% off of its record highs. What we're seeing is less of a meltdown, so to say, and more of what traders call a summer lull. Markets have been moving sideways in a narrow range for quite a while now, waiting for a huge catalyst that's coming up. And the big one that everybody's watching is this Friday's Jackson Hole event, which takes stage with Jerome Powell, and everybody's going to be watching this. Now, as far as rate cut expectations, just a week ago, traders were expecting this 90% probability that the Fed would cut interest rates in September. As of today, that probability has slipped as low as 75%, reflecting more caution ahead of Powell's speech. A lot of people are expecting him to really defend against cutting rates because the Fed faces this delicate balancing act. On one side, inflation is still running hotter than they'd like it to at their 2% target, fueled in part by tariffs that are gradually flowing through to consumers as far as consumer pricing goes. And then on the other hand, the economy and the labor market are showing signs of softening. And we'll talk about more as far as the labor market here in a bit. But equity investors are hoping that rate cuts will provide at least some type of relief, and especially for rate-sensitive sectors like real estate. But Fed officials are not, so to say, agreeing with each other. Some see inflation risks as still too high for them to support cutting rates, while others worry about weakening job growth and don't necessarily want to react too slowly to the signs of concern that they are seeing. And that division that we're seeing makes Powell's Jackson Hole speech especially important just based on what to expect at this September meeting. Now, one of the more fascinating debates emerging now is how tariffs are filtering through the economy. So right now, higher income households, mainly those earning above $100,000, are driving most of the summer spending that we're seeing, while lower and middle income families are tapped out after a years, I guess, of inflation and higher borrowing costs. Rockefeller's Global Jimmy Chang warned that tariffs will increasingly weigh on consumers through and beyond 2026, creating a weaker consumer base. And his point is simple. Companies may eat some of the costs up front, but eventually those higher prices will hit the households and they will begin to pay. They as in the consumer like you and I. And that's where the political conversation gets pretty interesting, because there's a Republican-led proposal floating around Washington to send tariff checks directly to households, essentially using tariff revenue to issue cash payments, maybe in the form of $500 to $600. And the idea is that families of four could receive around $2,400, similar to a stimulus check during the pandemic, but it's a little different. So if this is passed, that could temporarily boost spending, especially heading into the holiday season. And I think what we should look at just if that happens is, let me pull it up real quick. You see this bottom left chart right here? Look at what happened to Bitcoin during the stimulus check period, and of course, not investment advice or a recommendation for you. Who knows what could happen? But here's the rub. The bond market could likely hate it. And the reason why is because we're already running a massive federal deficit, and turning tariff revenue into cash payments adds another layer of fiscal stimulus at a time when the government is already borrowing super heavy due to this tax and spending bill. And that could put upward pressure on treasury yields and inflation expectations, in a way causing more inflation, causing treasury yields to go higher, which means borrowing costs even higher, and it had the complete reverse impact of what they'd like to happen. So what's really happening behind the recent stock market is up to question. Analysts like Citigroup's Scott Cronert, what a name, argue that this isn't the start of a bigger downturn. It's just more of a portfolio rotation. The S&P 500 has rallied 32% since April, and the NASDAQ has surged 45%. And at some point, investors will begin taking profits, especially in big tech and AI names. And the result has been a short-term pullback for what's called the Magnificent Seven. Plus, companies like Palantir and Broadcom are in that mix. But look deeper, like defensive sectors like real estate, staples, healthcare, utilities, all of those have been gaining ground lately. Energy, materials, and financials are also ticking higher, just to add to your list of watching. But what that tells us is that this isn't necessarily a panic yet. It's just rotating money across the market. Even a 5% pullback wouldn't necessarily be considered crazy. It would actually be seen as normal. And a 10% correction usually requires a more real shock in comparison. Now, the sharp pullback in big tech is seen as painful, but it's not like 2000 all over again where we seen that .com bust. Yes, we got Nvidia, Meta, Apple, and Palantir. Those companies have lost some ground, but unlike the .com bubble, today's tech leaders are delivering real earnings growth. Tech earnings this year are up more than 25% compared with just 7% for the rest of the market. Now, valuations are seen as high, yes, but far below .com levels. We just talked about the Magnificent Seven, but that ETF now trades at about 31 times forward earnings, which is down from over 40 just last year. And in 2000, Cisco and Oracle were trading at 132, even as high as 150 times earnings. So yeah, pullbacks are normal in bull markets driven by new technology, but AI is still early in its monetization cycle, and leaders like Nvidia remain far ahead of its competitors. And what that suggests is that this AI-driven tech rally has much more room to run, even if volatility continues to persist. But of course, anything could happen. Now, let's talk about the housing market because it also deserves some attention. After years of being frozen by these higher costs, higher rates, prices are showing their first signs of cooling. Now, nationally, home prices in July rose just 0.2% year over year, which is the weakest reading since back to 2023. In parts of the South and the West, prices are actually even falling. Sales activity has ticked up about 2% month over month. And the reason why is slightly lower mortgage rates and a growing pool of inventory. For the first time in years, buyers are gaining some leverage with 20% of listings cutting prices. So if you're in the market for a home, what do they say? They say, marry the house, date the rate. So you could always refinance later, assuming you believe mortgage rates could go lower from where we're at right now. And we just talked about mortgage rate. Well, borrowing costs going up because treasury yields going up in the case of the stimulus. So just be on the lookout for that. A 5% national price decline wouldn't necessarily erase the 50% surge we've seen since before the pandemic, but it would matter for recent buyers. And if rates continue easing below that of 6.5%, more buyers could step back into the market this fall. But we'll keep on watching what happens. Meanwhile, the labor market, and this is what I said we talk about a little later as far as the economy easing and some Fed members watching, because the labor market is beginning to show cracks. So what we got is the Conference Board survey found in 1 in 5 employers plan to slow hiring in the second half of 2025, which is nearly double the rate of just last year. And now it takes the average worker 24 weeks to find a job. Almost a month longer than just a year ago, which is completely crazy if you're looking for a job right now. Job growth is slowed, layoffs are beginning to tick up, and even major players like Meta and Novo Nordisk are pausing recruitment right now as far as AI plans in development. And this isn't a collapse, but it signals companies are cautious and they're trying to do more with fewer employees, leaning into AI and automation instead of expanding headcounts, which is the whole problem we had with AI in the first place while we were looking at how all of these large companies were pouring billions and billions and billions of dollars into their AI infrastructure. Now, one bright side, though, is that business activity is beginning to heat up. The S&P Global Composite PMI rose to 55.4, which is the strongest pace this year. Manufacturing in particular surged to a 39-month high, signaling that factory activity is rebounding. So there's a plus. But the cost side is less encouraging as tariffs pushed selling prices to their fastest rise in 3 years. Which, what does this do? Think about it. That complicates things for the Fed because stronger activity plus higher prices looks more like a reason to ease away from cutting rates or even raise them rather than cutting rates like everybody would like. But raising rates, nah, maybe they just threaten to raise rates, in my own personal opinion. So where does all of this leave us that we're talking about today? We got stocks cooling after this massive rally we've seen since Liberation Day, but we're still near record highs despite this coolness that we're seeing. The Fed is caught between cooling or slowing growth and sticky inflation. Consumers are split. We got these wealthier households are keeping the economy afloat while lower income families are really feeling the struggle and the pain out there. Tech pullbacks look more like corrections than collapses as people are rotating their portfolios. We got housing is slowly thawing, but affordability is still a major issue years after that affordability concern came up. And Friday's Jackson Hole speech by Powell could be the spark that sets the tone for September, so keep on watching that one. The market is holding its breath, but investors want clarity on rate cuts, but Powell might remind them that not to get ahead of themselves as far as rate cuts. So either way, the next few weeks will be crucial in determining whether the market keeps climbing or whether volatility finally takes center stage. Everybody, I'll see you there, and good luck out there.